That is in focus after reporting their third quarter numbers. ET Now Sajid Mangat spoke to Sandeep Kalra, CEO at Persistent Systems, and asked him about the company's future plans and the way forward. Listen in.
Hello and welcome to ET Now. You're watching Earnings with ET Now, and my guest today is from Persistent. Uh, the the company came out with earnings which are much better than street expectation, and joining us today is Sandeep Kalra, who is the CEO of the company. Sandeep, thank you very much for joining us today. Good set of numbers. Quarter on quarter jump of 4.1% on constant currency term for revenue, which is much ahead of street expectation. Can you take us through the demand and supply situation which is there, and what's boosting this top line growth?
Sure. So first of all, good morning to you and your viewers. Let me just start with a full view to the quarter, and then I'll dwell into the demand side of it. As you rightly said, it was constant currency 4.1%. We delivered $422.5 million, and this was 17.3% in dollar terms year on year. One thing that I'll point out upfront is there was a change in the labor code. So as per the new labor code, the IT sector, I'm pretty sure most of our companies have taken a one-time hit. So we had a one-time impact of 2.3% on EBIT margin and 1.8% on PAT margin. Before this hit, the EBIT margin was roughly at 16.7%. Post this, it came in at 14.4%. Same on the PAT side. The PAT would have been 13.4%, but for this one-time, charge that we had to take or provision that we had to make, and it basically adjusted for that, came in at 11.6%. Now, in terms of the demand environment, we continue to see a decent traction for our services. Now, the macro is where the macro is. We had seeded a series of discussions over the last several quarters with our customers on AI-based deals, where we were seeing newer opportunities, whether it was doing product development or application development faster using our platform called SASVA, whether it was doing application modernization or data modernization using our other tools like Iora or GenAI Hub. And I'm proud to say some of these have yielded good order books. So in the last 2 quarters, if you were to look at it, we have had good bookings that is translating into the uptick in revenues. And that's where we are seeing, irrespective of the macro, whether it's banking, financial services, we are growing today at roughly about 30% year on year. Similarly, high tech and healthcare also, we have seen pretty good deal wins and good growth.
Sandeep, what was interesting was your 16.7% EBIT margin despite a salary hike which came in the quarter. How do you see this EBIT margin going on from here on? Do you see enough headroom to take it forward, or are you going to look at reinvesting the gains into the business?
Yeah. So as you would realize, AI is a pivot in our industry. And as of this point in time, we are ahead of the curve. We have invested in building our capabilities, whether it is capabilities in different industry verticals or in our platforms that do software development lifecycle, data modernization, application modernization, and so on. Our endeavor would be to keep the margin between the 16 to 17% range and reinvest the rest in making sure that the capability build continues, because AI is a very fast evolving field, and that will keep us in good stead as far as our growth momentum is concerned.
Interesting that you're saying the reinvesting into AI products and platforms there. If you can give us an indication of the kind of investment that you're looking at or to reinvest into these platforms, to give us a perspective of how aggressively you're following the AI services strategy.
Yeah. So we don't quantify, because then it becomes another reported metric on a quarter basis, and then every quarter you will ask us to report that as well. But if I was to give you a sense of where we are heading, so there are three predominant plays that we have. So first is in the software development lifecycle, where we are investing very heavily into a platform called SASVA, which does end-to-end product development, right from requirement gathering to getting it into technical grooming to doing coding, integrating with coding assistants, or having a native coding assistant inbuilt into the platform, doing release management and 9 yards. Now, this can be used in software product companies for doing software product development or in enterprises for doing application development. Similarly, we have two products for the enterprise side, the CIO or the business side. And that's where, if you look at it, we have the GenAI Hub and Iora combined, put together at any point in time. There is about 350 to 500 engineers over the last 18 to 24 months who have been working on building these platforms, enhancing these platforms, working with partnerships, whether it is hyperscalers or specific partnerships such as Databricks, Snowflakes, and industry-specific partnerships. So that's where our foray is, and this is what is driving our consistent growth. While the industry may not be growing at that clip, and that would be our endeavor to continue that.
Give me a sense of the TCV or a color of your TCV, because you did roughly around $675 million in TCV in this quarter.
Yeah.
What percentage of that would have AI inbuilt into it, or is it entirely AI inbuilt into it? And
Yeah.
I was looking at your revenue per employee metrics, which has been stable at this point in time, which also gives me an indication that AI revenues are coming in, but at the same time there's an AI deflationary revenue which is mapping it out, or taking the entire surplus out. Give me a sense of how it's planning out, because you've been one of the companies which are ahead of the curve, and you will see the headwinds first with respect to revenue deflation coming in first.
Yeah. So I'll start reverse here. So while we are ahead of the curve, doesn't mean that we will see the deflation come in first. What we are attempting to do, and if you look at our last 4 years, we have grown at a CAGR, compounded annual growth rate of 25% plus. As of this point in time, we are growing at about 17% year on year, which is a fairly healthy growth rate compared to where the industry is. Now, what that means is not only are we doing well in our existing customers, we are also winning newer deals at scale in newer customers. So we are being brought in as a challenger by many large brands, large product companies, large enterprises across banking, financial services, healthcare, life sciences, and the tech ecosystem. Now, why are we brought in? Because we have built a certain set of tools which may be useful in the current programs, or the customers believe that while they may not be using AI big time in their current programs, we are the right partners to handhold them into the AI world as they move into that. So if you now juxtapose that into your question, the AI revenues for most of the companies in our sector, which are true AI revenues, are high single digit at max for companies like us, or low double digit. And for many companies, they are much lesser. Now, will AI get embedded into everything that we do? That is the way we are looking at it. So it is not this that there will be AI standalone and there is the rest of the world. AI will get infused into every one of our services, whether it is a horizontal service or a vertical specific work that we do. And that's our endeavor. We are looking at every part of our business and we are infusing AI into it. And down the line, I don't think anyone will talk about AI revenues and other revenues separately. It'll be all the tech services from our point of view. The leaders will embed AI into it and there'll be no more demarcations. So that's the journey we are on.
What is the kind of view that you have with respect to new orders, especially with clients asking for cost takeouts? Are you able to do that in a much effective manner? Are the orders to begin with smaller and then get scaled up as the proof of concept gets evolved?
Yeah. So there are two distinct buckets. So when you're talking of proof of concepts are not for cost takeout. Proof of concepts are more for transformation, more for newer opportunities that are emerging. See, with AI, what is also happening is traditionally a lot of work that people could not do. Let's say there were legacy applications where the people who built those applications over the last 20, 30, 40 years, they're gone. They may be mainframe based, they may be COBOL based, they may be others, and so on. Complex problems to solve. If it is not broken, don't fix it was the mantra so far. Even if by fixing it, you could do much more efficient, business in terms of cycle times, in terms of regulatory compliances, and so on. AI tooling is giving us the ability to unleash that market, open a newer addressable market. So that is where the proof of concepts come in first. We go in 3 to 6 weeks, 8 weeks, max proof of concept, show to the customer we can unlock that, and then that follows downstream with a bigger, kind of downstream business for us. So that is where the proof of concepts unlocking bigger value is. As far as cost takeouts are concerned, that is where the AI part enables anything that is repeatable, anything that can be commoditized, application support, infrastructure support, business processes. That's a second bucket. So that is also a bucket that increasingly we are playing. Earlier, we may not have been the right players for that, but with our AI progress, automation, and so on, we are being brought into those deals and we are also winning those.
How are you looking at your, the guidance that you've given out that by FY27 Q4 you will have a $2 billion revenue run rate? Are you on track to meet that? And then thereafter you have a bigger target of $5 billion by FY31. Is that also on target for you?
Sure. So just one correction. It's not a guidance, it's our aspiration. Now, we said our aspiration is $2 billion, FY27, run rate exit, which means March 31st of 2027, when we exit, our quarterly run rate should be such that we should be touching that $2 billion or more. And if you look at our trajectory, currently the $422 million plus, multiply that by 4, that gives us 1688, more like, closer to $1.7 billion. Juxtapose the growth rates, that's our aspiration. And with a small bit of M&A, that's what we said in any of our earlier calls. So if we do all that and execute impeccably, our aspiration would be to hit that. That lays the foundation for the next, and with a small bit of acquisitions over the next, 4 or 5 years from now, hopefully we will deliver to the aspirations. That is where the entire team is focused on.
Yeah.
Okay, so the management guidance continues to remain on track, or rather, as the management said, they aspire to achieve a run rate of $2 billion by the fourth quarter of FY27 and $5 billion by FY31. That's the word coming in from the management of Persistent Systems. On that note, we